Hey there, it's Jared Hamilton with the Hamilton Group at Cherry Creek Mortgage, and welcome to another edition of Java with Jared. Hope you guys are doing great. Sorry about those Broncos. I guess we won't have that to talk about over the next couple of weeks, but I wanted to get with you, let you know what happened with interest rates. And listen, I've got some really great graphs to show you, and I'm going to try to make this as quick as possible. I'm going to talk quick because I got a lot of data, but this information I think is really important. So, first of all, what happened with interest rates this week? Got a little bit worse than the end of last week. And I'll tell you why here in a second. Tuesday we saw the CPI come out, and the producer price index came out a couple of days after. Producer price index came in at a negative 0.2% decline. That was worse than what the market expected. Core came in right at about what was expected at 0.1%. The consumer price index came in at 0.1% increase, just as expected, and the core rate was 0. So that showed that inflation is really under control, which is really great for interest rates. Inflation is interest rates' biggest enemy, and so the CPI and PPI showed that inflation is pretty much non-existent. Retail sales came out slightly stronger than expected, but not a big deal. But on Thursday, this is what caused interest rates to get worse. We saw economic data that came out from the housing industry that showed some strength, and that caused stock market to really rally, thinking, hey, the economy is going to get better. Money moved from stocks or out of bonds into stocks. That caused interest rates to suffer. What happened is building permits came in about as expected, but housing starts came in at a 12.1% increase from the previous month, which was a huge increase. It was the biggest increase since June of 2008. Housing starts came in at 954,000 on an annualized basis, which was a big surprise. Now, we know that the housing industry is recovering because inventories are super duper low. Well, it became a little bit more evident, and so people on Wall Street thought that's good news to celebrate, and stocks have increased. Now, I don't think this is a long-term trend. I think the economy still, is going to be suffering, and especially we see how some of these tax increases translate into that. So I don't think it's an overall trend, but rates did deteriorate a little bit. They're still at really good levels. Okay, now on to these graphs, and this gets to my title. My title is, are you going to make 2013 happen or let it happen? And there's a difference, and I'll explain that to you. But I wanted to get you these graphs because it does talk about how things are improving in the housing industry. I have these graphs included, but I think that you should use this to talk to your clients. It shows that this first graph here shows how low inventories really are compared to the normal, and we know that is happening. This next graph is from Case-Shiller, and it shows the home price indices, and you can see how this trend from the beginning of middle of this year has really been positive. So we're seeing some appreciation there. This graph shows some experts' prediction in the projected change of home price in 2013. We got J.P. Morgan saying it's going to come in really high. Freddie Mac, still thinks it's going to be a normal and healthy market. I've got a few graphs here from the Homebuyer Expectation Survey from a group called Pulseonomics that is really interesting, and I can give you the link on that. But this shows here how we saw normal appreciation rates 1987 to 99 of about 3%. Well, then we had the bubble, and things increased about 10.4%. And then we had the correction down to 5.7%, and now they're expecting things to increase about 3.3%. Shows it's just back on the normal graph. We had the bubble, and then it corrected, and now we're back to normal. This graph shows their estimate on the cumulative appreciation over the next few years in 2016, and this is cumulative. Prices could rise from today about as much as 19%. That's just, again, cumulative in the fourth quarter of 2016. This graph shows, again, projected change from some of the experts on home prices in 2013. And this graph shows that the consumer is believing that prices are going to increase as well. From the first quarter of 2012, we only saw an increase of, expectation of 34% thought that home prices would appreciate. Now we're talking about 71%. So the consumer psyche is really changing. So here's what's important about these graphs. Again, use them to talk to your clients. And again, make 2013 be a great year. If you let 2013 happen. I still think it's going to be a great year. You can just let it happen. I think it's going to be a really good year, again, for real estate. But if you make it happen, if you get out there right now and start talking to your clients, because there's pent-up demand out there. They know that people have been wanting to buy for a while, but they couldn't because their home, they're afraid that prices will continue to decline. That may not be the case anymore. And get talking to them today. Talk to them about these numbers. If they've been thinking about buying, you're going to make 2013 even better. So hopefully that's some good info. If you want to discuss it in greater depth, give me a call. Thanks for joining me with Java with Jared. Hope you have a wonderful weekend, and I'll talk to you next week. All right? Take it easy.